Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Investor in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together we're going to make the best investments that we can, so thank you so much for joining us. And on today's show, we have my friend and one of my favorite investors, Shailesh Kumar from Value Stock Guide. You may be thinking, well, who is Shailesh Kumar and what is Value Stock Guide? Well, I'm going to tell you. Shailesh is the man behind Value Stock Guide. He runs the portfolio, and since inception, the portfolio there has returned 209%. In that same time period, Berkshire Hathaway, aka Warren Buffett, has returned 131%. So if you're keeping score, that's 209% for Shailesh Kumar, 131% for Warren Buffett. Need I say more? In today's show, Shailesh and I are going to have a conversation, and we're going to talk about where does he believe some of the best value can be found right now in a market that is highly overvalued. He's going to talk about how he diversifies his portfolio and how he builds his portfolio, and lots of other great wisdom and advice from Shailesh, as always, when we have him on the show. So I hope you'll enjoy today's show with Shailesh Kumar. And don't forget that our goal here is to help you learn to invest. That's financially and in all of life. You can always find more at investorinthefamily.com. The average self-directed investor earns annual returns of around 2.9%, and one of our goals here is to help change that. And I've created a simple resource called the Purchase Filter, which is a 10-step checklist designed to help prevent you and me from making bad and emotional investments. This really could be a game changer for many of us. If you want this resource, simply text the word filter to the number 44222 or sign up over at investorinthefamily.com. We'll make sure to get you that filter into your hands. And also, if you're looking for a way to support Invest in the Family Radio, you can do so simply by going to investorinthefamily.com/Amazon instead of Amazon.com next time you want to go to that website. And you will be redirected from our site to Amazon. Everything will be exactly the same for you. No extra cost at all, but a percentage of everything you purchase will come back to us as a way of saying thank you. So thanks in advance for that support, and hope you enjoyed today's show with Shailesh. Well, hey, Shailesh, welcome back to the show.
I'm glad to be here, Brian.
Well, we really had a great time when you were on the show several months ago, and I wanted to kind of get back on the phone now and kind of catch up a little bit on what you're up to now and what your views are on some current things going on in the markets. So to get things started, I'd love to hear a little bit about what are you watching right now in the markets with PE values as high as they are and a lot of talk about the markets being overvalued. What do you find interesting right now?
Well, the market is overvalued if you look at it overall. The thing is, and this is kind of true in almost all market conditions, even when the market is overvalued, there are some pockets here and there which are depressed, or they could be in the bear market. So right now I'm looking at commodities, for example, that they have taken a beating over the last couple of years. And as it happens, and this doesn't really happen that often, but this time, almost all different commodities have gone down about at the same time. So normally you will have diversified miners, who may be mining for nickel or copper or gold or whatever. If one commodity goes down, they have other commodities that kind of keep them afloat or sustain their earnings. But this time, it has all gone down around the same time. And this being a cyclical industry or cyclical sector, I think this is probably a very good time to find some good names and kind of enter into a position and just hold out for the long term. The other sectors are similarly cyclical that I'm looking at. I'm looking at shipping as well. I've actually been in a shipping stock for some time because the downturn has been going on for some time as well. But I think this is a good time to take a look if you haven't already.
So tell me, why do you think commodities across the board right now have all been so depressed as opposed to usually this a little more selective in the past?
Well, we had, so in the past, the global trade used to be a little bit more spread out. But over the last many years, China has emerged as one of the largest buyers for almost every commodity out there. And so for most of the companies, most of the trade in commodities has been one-way street to China. And So essentially, what has happened is okay. So there are two things. One is the Chinese economy has kind of slowed, and that has kind of reduced the demand for majority of the commodities out there. And number two, of course, when times were good, uh, these companies spent quite a bit, invested quite a bit in new capacity, and so they are now sitting with large supplies, which there's not enough market right now. So it is a supply story as well as a demand story right now, and I think China is the big driver.
So when you have a scenario like that where so much is dependent upon one country, primarily like China, and that's causing significant downturns in most commodities as well as shipping, like you said, what do you look for to get an idea of when, it's time to get in as opposed to jumping in too early?
Well, in most cases, you really cannot avoid. It's very, very hard to time the market bottom precisely. So what you would like to do as an investor is to have some idea of, where you think the company that you're looking into or that you're interested in will be in the next 5 to 10 years. And you can go back in the history and see what their market share has been when the times were good. And hopefully the company that you're looking into right now is a strong enough company to survive and even expand their market share as the cycle turns up. So essentially, it's just taking a position. If stocks become even more attractive than they are today, be prepared to buy some more, as long as you are pretty sure that you're buying into a good company.
And when you talk about commodities, are there any, you mentioned like different varied companies that have a wide variety of commodities that they mine. So I guess mining sectors are some of the areas that you're more interested in right now.
Right. But again, I'm not going to overexpose my portfolio to any one sector. So I do want to keep it diversified. But these are the areas that are kind of interesting today. But if I don't have any other good ideas, given the market is as overvalued as it is today, I'm happy to stay in cash where I need to.
Right. When, as far as the overall market being overvalued, like you said, I guess that really doesn't concern you very much, really, because if you're looking for, like you said, even when the market's overvalued, there's still pockets of undervalued segments. So I guess that really doesn't affect your strategy at all, does it? If the overall market has high PE levels?
Not really. I'm fond of saying that a value investing portfolio like mine tends to be a self-correcting portfolio. So what I mean is that in times when the market is overvalued, really, I mean, if you're looking for value and you don't find any value, you're not going to invest in new ideas or many new ideas. And, there may also be times where you're selling off some of your existing holdings. On the other hand, when the markets are cheap, you will have a lot of opportunities out there and you'll buy number of stocks. So to me, it doesn't really concern me. The problem with many investors is, they have itchy fingers. They really want to press the buy button, right?
Very difficult, yes.
I have cash. Why can't I buy? And so as long as you're over that novelty of buying and selling stocks and you're into this thing for investments and not speculation, you should be fine. It's actually not a big deal if you have to stay in cash for a while.
And so any talks out there about, concerns regarding future market corrections or crashes or whatever else, you pretty much just ignore all that, I assume, right?
Well, I mean, I do not concern myself with those hypotheses because, there's a saying that the economists have predicted I guess, 150 out of last 100 recessions, right?
Right,
Okay,
right.
so something like that, right?
Right.
But the thing is, it's like the crowd is almost always wrong when it comes to economics. And the question is, am I any better qualified than, those career economists in predicting? And I don't think I am. So I'm not really going to concern myself with those predictions or speculations. What I'm going to do is what I do best, which is, try to find ideas. And if there are no ideas, just stay put and wait. And the staying put and waiting part is if the market correction occurs, I have cash, I can buy more, or I can buy new ideas.
Right. No, I love it. I love the discipline and the focus of that. And the fun thing about having a podcast like this is I get to spend a lot of time talking with great investors like yourself. And time again, that's the theme, that just wait for opportunities. If you're just willing to be patient and wait for great opportunities, things work out for you over the long term. But like you said, that itchy finger dynamic is what gets so many people. And it all comes back then at that point to the discipline, conviction, and psychology of the investor, which ends up being the biggest enemy to most of us, I think.
Absolutely. And there has been a study, and I can look it up, or the listeners can look it up as well. There's been a study that if you look at any of the best performing mutual funds over, last 10 years, for example, you'll find some funds that have performed really well. But then if you dig deeper and you look at the average investor who invested in those funds during that time period, most of them lost money, even if the fund has performed well, because the investors are their own biggest enemies, and they tend to buy and sell at the wrong times. If you had just bought and done nothing, you would have done really well.
So convicting, but so great to hear. I love the themes that come up over and over again that are so significant, because all of us being human, usually to hear those things over and over again. Earlier, you talked about not wanting to overweight too heavily in any one sector. Specifically, we were talking about miners at that point. How do you go about diversifying your portfolio in a way that is less correlated? Is there any specific strategy, or is it just, hey, I realize this sector has enough, so I want to make sure and move to another area?
Well, I don't. It's kind of my strategy is quite loose, but also I have a few very well-defined rules that I play by. So, for one, I do not want to buy into any sector or any given stock, expose myself for more than 10% of my portfolio. So that's one. So that kind of right away tells me that I'll have at least 10 stocks in the portfolio, right? And the second rule that I have is that in any given sector, I will only have one holding.
Okay.
Right. So if I'm buying a commodity, in commodities, for example, I'm going to only buy one stock in that commodity sector. So that kind of forces me to find the best idea in that sector instead of, trying to hedge my way through it. I'm actually forced to look into the best possible idea. And I think that actually works out quite well, but that also forces me to, if I want to have 10 stocks in my portfolio or more, I need to be exposed to 10 different industries in my portfolio or more, right?
Right.
So that's how essentially I diversify. I generally do not play the correlation game saying, hey, mining is uncorrelated to financials, so let's have one miner and one financial. I do not try to do that. But if you get exposed to 10 or more industries, you are generally well diversified.
Right. No, I like that. I always like hearing when people have specific rules, because first of all, that's helpful for the rest of us to learn from. And I find that the more clear rules we have to operate, the better that mitigates what we said a while ago. When the emotions and lack of patience start coming in, we can go back to those rules and say, okay, this is what's going to govern my decision making, not my current state of mind. So I always love hearing things like that.
Absolutely.
You mentioned shipping earlier. Could you talk a little bit more about when you say shipping, are you referring to any type of shipping, and what about shipping do you like?
Well, I'm looking at dry bulk shippers. So these are shippers that transport mostly raw materials. So these are the commodities which are very early in the production cycle. So the shippers may be transporting iron ore, for example. They may be transporting grains. They may be transporting, sometimes the finished product like cement or whatever. But majority of the stuff is like very early in the production process. The thing with dry bulk shipping is you can pretty much say that it is a leading indicator for global economy, right? So people buy more iron ore when they are producing more products like steel, right? So the buyer for iron ore has already looked a year into the future and kind of trying to figure out what my demand is going to be 1 year later, right? Which is whatever the lead time is for production. So it kind of gives you a leading indicator of the global economy. So that's one. But this is the dry bulk shippers I'm looking at. This has been an industry that has been scraping the bottom for a few years now. And the reasons are actually twofold. One, the global trade has kind of slowed down in the last few years, so the demand side has slowed as well. And the second reason is that these guys have been buying or ordering a lot of new ships, and so there's a lot of ships on the waters right now. And until those ships kind of go away, so for example, they actually have to send them to the scrapyard, there is so many ships on the water that the supply of the ships is quite high, and so they cannot really command a good spot rate. So right now, the spot rates for chartering a ship, a dry bulk ship, is well below their break-even cost for the day.
And is that what the Baltic Dry Index is? Is that what you're referring to?
Right.
Okay.
Right. The Baltic Dry Index actually it's a combination of 3 different sizes of ships, and it tracks the spot rates, and it creates an index based on those 3 different spot rates.
Great.
Right.
And so in that industry, there's an excess supply of ships, but you said it's been scraping bottom. The spot rate has been scraping bottom for a long time, and I guess you see maybe a little bit of thinning out happening with ships, maybe more being sent to the scrapyard, and which, that being the case, would possibly open up the doors for some investment opportunity.
Right. So in the past few years, we saw a lot of shipping companies actually go bankrupt. But the problem is when these companies go bankrupt, it doesn't really do much to reduce the supply of the ships because somebody else takes over those ships and they're still there, right?
Right.
So now this year, we are seeing a lot of companies actually, scrapping their ships. So they're not going to try to wait out the downturn anymore because there's no point. And it's actually costing money to keep the ship alive. So now they have started to kill those ships, and that will actually be the final turning point for the industry.
Excellent. Well, thank you for spending a few minutes with us and walking through some of the sectors that you see right now, especially when there's so much talk of the market being overvalued, which is obviously legitimate, but knowing that there are opportunities out there is helpful for all of us. Before we wrap things up, I'd love to. I didn't ask you in advance to prepare for this, so you may not have anything on the top of your mind. But obviously, you are a value investor, and I highly respect you as a value investor. And I'm curious for our audience: are there any people out in the audience wanting to learn more about value investing or grow as a value investor, do you have any favorite resources that you could recommend, whether it be books or otherwise, that maybe they could turn to learn and grow in that area?
Well, if you go to valuestockguide.com and on the homepage, if you scroll down to the bottom, there's a link that you can click that says books or something, or reading resources, or something like that. So you go there and it's a listing of all the books, and I have actually sectioned that page for a beginner, investor, intermediate, and advanced. So you can figure out where you fall into this, and you can go through that reading material over there. Perfect. It covers quite a bit of ground.
Sure. Yeah. Obviously, lots to cover there, and not a small question at all. So, well, we'll be sure and link to that from our show notes page and stuff. So anyone out there listening wanting to find that, you'll be able to find that through notes. And hey, Shailesh, always a pleasure to have you here with us on the show, and thank you so much for your time today.
Thank you for having me, Brian.
Well, I hope you enjoyed the interview with Shailesh Kumar. Remember, you can always get full show notes with links and other details at investorinthefamily.com. If you want to receive my purchase filter, simply text the word filter to the number 44222 or get signed up over at investorinthefamily.com and we'll get you set up. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.